Hi. Let's learn about liquidity ratios. Liquidity ratios are essential financial metrics used to evaluate a debtor's ability to pay off current debt obligations without the need to raise external capital. These ratios measure a company's ability to cover debt obligations and its margin of safety by calculating metrics like the current ratio, quick ratio, and operating cash flow ratio. Liquidity is the ability to convert assets into cash quickly and inexpensively. Liquidity ratios are most useful when used comparatively, either for internal analysis by comparing multiple accounting periods, or for external analysis by comparing liquidity ratios of companies within the same industry. A higher liquidity ratio indicates a company is more liquid and has better coverage of outstanding debts. The current ratio measures a company's ability to pay off its current liabilities using its total current assets, such as cash, accounts receivable, and inventories. The higher the ratio, the better the company's liquidity position. The quick ratio measures a company's ability to meet its short-term obligations using its most liquid assets, excluding inventories from its current assets. It is also known as the acid test ratio. Days sales outstanding refers to the average number of days it takes a company to collect payment after making a sale. A high DSO means that a company is taking too long to collect payment and is tying up capital in receivables. DSOs are generally calculated on a quarterly or annual basis. Despite a company's health, a liquidity crisis can occur due to circumstances making it difficult to meet short-term obligations. The 2007 to 2009 global credit crunch is a prime example of this. However, a liquidity crisis in a solvent company can usually be resolved with a liquidity injection, using pledged assets to raise cash to tide over the situation. In contrast to liquidity ratios, solvency ratios measure a company's ability to meet its total financial obligations and long-term debts. Solvency relates to a company's overall ability to pay debt obligations, while liquidity focuses on current or short-term financial accounts. A company must have more total assets than total liabilities to be solvent, while it must have more current assets than current liabilities to be liquid. Liquidity ratios like the quick ratio, current ratio, and days sales outstanding are essential for assessing a company's financial condition and its ability to cover short-term obligations and cash flows, contrasting with solvency ratios which focus on the ability to pay ongoing debts. Here are 3 key takeaways. 1. Liquidity ratios are financial metrics used to determine a company's ability to pay off current debt obligations without raising external capital. 2. Common liquidity ratios include the quick ratio, current ratio, and days sales outstanding. 3. Liquidity ratios determine a company's ability to cover short-term obligations and cash flows, while solvency ratios are concerned with a longer-term ability to pay ongoing debts. Hope this would help. Thanks for watching.